Blue Chip Bulletin. Financial market updates and insights.
Have you ever seen this happen? A company comes out, reports fantastic news, only to watch its stock get completely annihilated. Well, that's exactly what just went down with the database giant MongoDB. I mean, they delivered a stellar quarter, beat expectations on both the top and bottom lines. So why in the world did Wall Street thank them by sending the stock into an absolute freefall? Okay, let's dive into this paradox.
Yeah, this is the number that just, wow, it left everyone speechless. In the hours right after they released their earnings report, MongoDB's stock plummeted by more than 20%. It was a brutal gut punch of a reaction that, on the surface, seems to make absolutely no sense, especially given the strong results the company had just posted.
So what on earth is going on here? Why did the market hear good news and immediately just slam the sell button? To unravel this, we have to start with the good news, the stuff that seemingly got lost in all the noise. Let's first take a look at the numbers that, in any other context would have had investors celebrating. Because by any standard metric you look at, MongoDB's fourth quarter performance was incredibly impressive. Now, what's really interesting here is the quality of the beat. Revenue clocked in at over $695 million, totally smashing the $670 million consensus. And earnings per share, or EPS, hit $1.65, a full 17 cents above what Wall Street was expecting. Look, this wasn't some tiny beat. This was a decisive outperformance. For a company of this size, beating estimates by this much is a huge sign of strong execution and demand. And it wasn't just the headline numbers. The company showed real strength where it really counts, with its highest value customers. They now have nearly 2,800 clients spending over $100,000 a year. This shows that large, serious enterprises are building their core applications on MongoDB, which is a fantastic indicator of the company's underlying health. So with all this good news, where did it all go so wrong? And this is where the story takes a violent turn. Because for a premium-priced, high-growth tech stock like MongoDB, the past is interesting, sure, but the future is everything. And it was the company's forecast for that future that sent a shockwave of fear right through the market. This table right here is basically the scene of the crime. For the next quarter, the company guided for earnings per share that were lower than analysts had modeled. But the real gut punch was that full-year revenue forecast. Their absolute best-case scenario of $2.9 billion just barely meets the consensus, suggesting zero upside and, more importantly, a major slowdown. And this just illustrates the core problem perfectly. The company just posted a fantastic 27% year-over-year revenue growth, but their guidance for the full year ahead implies that growth is about to slow dramatically, way down to the mid-teens. For a company that's been a hyper-growth story for the last 5 years, a slowdown this sharp is pretty much the biggest red flag you can wave at Wall Street. And Wall Street did not mince words. Analysts at D.A. Davidson came right out and called the guidance ugly. The beautiful past just couldn't hide what they saw as an ugly future. A future that seemed to totally contradict the incredible promise of the AI boom. And to really understand this disconnect, we have to look at the massive expectations that were built around MongoDB's role in the AI revolution. You see, you can't analyze a company like MongoDB in a vacuum. Over the last year, the entire market has been swept up in this huge AI narrative, and MongoDB had skillfully positioned itself as a critical player in that new world, which set investor expectations sky high. This quote from Soster just nails it. MongoDB convinced the market it wasn't just another database company. It was providing the essential plumbing for the artificial intelligence revolution. And that story, it helped fuel its impressive stock run, but it also created a situation where any little hint of a slowdown would be punished severely. And the story was so powerful because, well, it's fundamentally true. MongoDB's technology is exceptionally well suited for AI. Its flexible data model is perfect for all that messy, unstructured data that AI applications are built on. It has native vector search, which is a critical piece for AI. The core logic was simple. More AI means more data, and more data means more revenue for MongoDB. This is what had investors so incredibly excited.
So this is the crucial point, this tension. On one side, you have the Atlas cloud database. It's the growth engine, right? It's 75% of the business and growing at a blistering pace. But on the other side, you've got these new headwinds. The weaker guidance implies that customers are starting to use less of their cloud services than expected. On top of that, the company's facing a $50 million headwind because fewer customers are signing those big long-term contracts, which could be a sign of broader uncertainty about future tech spending.
So, faced with a slowing growth story and a panicking market, what is the company actually doing about it? Well, they're not running from the problem. Instead, their strategy seems to be focused on doubling down on the very AI-centric features and long-term bets that got investors so excited in the first place. A center point of this whole strategy is the new integration with Voyage AI. What they're doing is embedding advanced AI models directly into their database. The goal here is to solve one of AI's biggest problems, hallucinations. When an AI just makes stuff up. By helping developers build more accurate AI apps, MongoDB wants to become an indispensable, high-value part of the whole AI development stack, insulating itself from these short-term spending shifts. And they're not just building products. They're out there hunting for future customers. By expanding their MongoDB for Startups program, they're making a direct play for the next wave of disruptive AI companies. The logic is brilliant. Get these high-potential startups building on your platform now for cheap, and when they become the next unicorn, guess what? Their massive data workloads are already locked into your ecosystem. It's a direct countermeasure to today's slowing growth. And while that growth story is hitting a speed bump, the company's financial foundation is actually getting stronger. This number represents their free cash flow from the third quarter. That's the cash left over after running the business. And this figure improved significantly from the previous year, largely because of disciplined cost management. It proves that even with slowing revenue growth, the company is becoming more profitable, which gives them the financial firepower to invest right through this downturn. You also have to look at the changes happening at the very top. The company brought in a new CEO, CJ Desai, as part of a long-planned succession. His deep experience in enterprise software and AI is a clear signal of the company's commitment to an aggressive AI-focused product roadmap. This move, along with recently hiring a new chief customer officer and the departure of some senior sales leaders, it all suggests a broader strategic shift away from pure sales and more towards a product-led growth model. So we've seen the great quarter, the scary guidance, and the company's long-term strategy. But how did the professional analysts, the people whose job it is to put a price on all this, how did they react to this flood of conflicting information? The verdict was swift and it was brutal. D.A. Davidson, the same firm that called the guidance ugly, chopped its price target from $360 down to $275. Bank of America followed right along, cutting its target from an optimistic $420 all the way down to $286. In essence, they're saying that because of that future growth slowdown, they believe the company is worth significantly less today than they did yesterday. And that leaves us with the million-dollar question, doesn't it? Was this 20% collapse a temporary emotional overreaction from Wall Street, or are we witnessing a fundamental, permanent reset in what investors are willing to pay for AI growth stocks in a tougher economy? The answer is going to tell us a lot, not just about MongoDB, but about the entire tech market in the year ahead. And while some analysts see this as a buying opportunity, rating the stock a buy, others are way more cautious, slapping it with a hold and highlighting the uncertainty that lies ahead. It's a classic battle between short-term fear and long-term fundamentals.